December 1999. A woman in Chicago walks into her basement storage unit and stares at her retirement plan. Not stocks, not bonds, not real estate. $30,000 worth of stuffed animals. Beanie Babies that were supposed to fund her golden years. That Christmas morning, she discovered every single one was now worth approximately $5, their original retail price. Across America, $10 billion in perceived wealth evaporated faster than snow on a warm sidewalk. College funds, nest eggs, divorce settlements that lawyers had fought over in courtrooms, all reduced to bins of unsellable plush toys, gathering dust in garages and attics. This is the story of how one billionaire toy maker named Ty Warner engineered the most brilliant and devastating speculative bubble of the 1990s. How he convinced middle-class Americans that stuffed animals were better investments than mutual funds. And how millions of everyday collectors lost everything when the Christmas music stopped playing and the bubble finally burst. Before we begin, if you enjoy stories about the financial events that shaped our world while most people weren't paying attention, please hit that like button and subscribe to The Sleeping Economist. Ring the notification bell so you never miss these educational deep dives into economic history. Now let's dive right in. Chapter 1. The $5 Billion Dream. In 1993, a 49-year-old former toy salesman named Ty Warner launched 9 understuffed plush animals called Beanie Babies. Each cost $5. Each contained plastic pellets instead of traditional stuffing, giving them a posable, floppy quality that kids loved. Warner sold them exclusively through small gift shops and specialty stores, never through major retailers like Walmart or Toys R Us. This wasn't an accident. This was strategy. Ty Warner understood something about human psychology that most toy manufacturers missed. Scarcity creates desire. While Mattel and Hasbro flooded big box stores with unlimited inventory, Warner deliberately restricted supply. Each store could only order 36 pieces per character. No exceptions. No bulk orders for Christmas. If a shop wanted more, they had to beg. For the first few years, Beanie Babies were just cute toys for children. Parents paid $5, kids played with them, and life moved on. But in 1995, Warner made a move that would change everything and ultimately doomed thousands of American families to financial disaster. He announced the first retirements. Warner declared that certain Beanie Baby characters would be permanently discontinued. Lovey the Lamb, one of the original 9, would never be produced again. Suddenly, a toy became an investment. If you owned a retired Beanie Baby, you possessed something that could never be manufactured again. Basic economics: limited supply plus growing demand equals rising prices. The secondary market exploded. Mothers who'd bought Lovey the Lamb for their daughters 6 months earlier discovered they could sell it for $40 on the emerging platform called eBay, a 700% return in half a year. Try getting that from your savings account. By 1996, Beanie Babies weren't in toy boxes anymore. They were in protective plastic cases, stored in climate-controlled rooms, cataloged in spreadsheets, and traded like penny stocks at elementary school playgrounds. eBay reported that Beanie Babies accounted for 10% of their entire sales volume. 10% of one of the internet's fastest-growing marketplaces was people buying and selling $5 stuffed animals. Warner's company Ty Inc. generated $250 million in sales in 1996. The next year, $700 million. By 1998, at the absolute peak of the mania, Ty Inc. recorded $1.3 billion in revenue. Ty Warner personally became a billionaire, his net worth exceeding $2.5 billion, by selling toys that cost approximately $2.50 to manufacture. But across America, ordinary people were making a catastrophic mistake. They were confusing a speculative frenzy with a legitimate investment strategy. And Ty Warner's brilliant marketing machine was about to crash into economic reality taking $10 billion of middle-class wealth with it. Chapter 2. The Retirement Trap. By 1997, Beanie Baby collecting had evolved from childhood hobby to adult obsession, and the word retirement took on a double meaning that would prove devastatingly ironic. When Ty Warner retired a Beanie Baby character, he stopped production permanently. The retirement announcements came without warning, creating panic-buying frenzies at gift shops across America. Store owners reported customers camping outside overnight, forming lines around the block, desperate to purchase the latest releases before they vanished forever. But here's the trap. Thousands of Americans started treating Beanie Babies as their literal retirement plan. Financial advisors watched in horror as clients withdrew money from 401ks and stock portfolios to buy stuffed animals. One West Virginia woman spent $100,000, her entire life savings, acquiring 20,000 Beanie Babies. A teacher in Ohio diverted money earmarked for her children's college funds into Princess Diana commemorative bears. Divorce lawyers in family court presented Beanie Baby collections as marital assets worth tens of thousands of dollars, arguing over custody of plush toys with the same intensity as fighting over the family home. Price guides fueled the madness. Publications like Beanie Mania and Mary Beth's Beanie World published monthly valuations suggesting certain rare beanies would appreciate 8,000% over the next decade. A peanut, a royal blue elephant, which had a manufacturing error creating the wrong shade of blue, was listed at $5,000. Collectors genuinely believed a $5 toy with a color mistake would fund their child's education. The speculation created its own self-fulfilling prophecy. As long as everyone believed Beanie Babies would increase in value, they did increase in value. The secondary market thrived on collective delusion. If someone paid $3,000 for a rare Beanie Baby today, the next buyer believed it would be worth $5,000 tomorrow. And so it went, prices climbing higher and higher, detached from any rational economic foundation. Ty Warner's retirement strategy was genius marketing and terrible for his customers. Every retirement announcement created artificial scarcity that drove up prices temporarily. But Warner was manufacturing the scarcity himself. He controlled supply completely. At any moment, he could flood the market with new releases, undermining the entire collector ecosystem. And that's exactly what started happening. By late 1998, Warner was releasing new Beanie Babies at an accelerating pace, dozens of new characters per year. The market was becoming saturated. But collectors, trapped in bubble mentality, kept buying. They'd invested too much to stop now. They needed the bubble to continue inflating because their real retirements, depended on it. The people buying $4,000 Beanie Babies in 1998 were counting on finding someone willing to pay $6,000 in 1999. They were playing the most dangerous game in economics, the greater fool theory. They just needed one more buyer, one more fool willing to pay more than they did. But the supply of fools was running out. Chapter 3. The Christmas Collapse, December 1999. Ty Warner made an announcement that should have delighted collectors, but instead triggered the crash. He was retiring several major Beanie Baby characters. In previous years, retirement announcements caused prices to spike immediately. Collectors would scramble to acquire the soon-to-be discontinued characters, driving values higher. The pattern had repeated consistently since 1995. Retirement equaled instant profit. This time, nothing happened. No buying frenzy. No price surge. No panic at gift shops. The market simply stopped responding. For the first time in 5 years, Ty Warner's artificial scarcity strategy failed to create demand. Collectors suddenly realized the horrifying truth. They were all holding the same cards. Everyone owned Beanie Babies. Everyone was trying to sell. Nobody was buying. There were no new collectors entering the market because the entire collector base was already saturated. Every person who wanted Beanie Babies already had them. Multiple copies? Dozens? Sometimes thousands. The greater fool theory collapsed because there were no greater fools left. eBay auctions that previously fetched thousands of dollars now struggled to hit 20. Price guides that listed certain beanies at $5,000 discovered sellers couldn't get $50. Gift shops that had restricted purchases to maintain fairness now couldn't give them away. The secondary market, which had sustained billions in speculative trading, evaporated in weeks. Christmas 1999 became the moment of reckoning. Parents who'd spent tens of thousands building investment portfolios of stuffed animals discovered they'd purchased expensive toys, not retirement funds. The woman who spent $100,000 on 20,000 Beanie Babies calculated she might recover $10,000 if she was lucky, a 90% loss. The teacher who diverted college money into Princess Diana bears realized she'd gambled her children's education on plush toys. Divorce settlements that had been negotiated based on Beanie Baby valuations became farcical. Couples who'd fought in court over $30,000 collections now owned $300 worth of orphaned toys. Lawyers had to renegotiate agreements because the assets they'd divided no longer existed in any meaningful financial sense. The crash accelerated through early 2000. As Y2K fears subsided and the dot-com bubble continued inflating, America's attention shifted to new speculative opportunities. Beanie Babies became a punchline, a cautionary tale about bubble economics. Ty Warner tried desperate measures. He announced the complete retirement of all Beanie Babies, then reversed the decision weeks later. He launched new product lines. He created limited editions. Nothing worked. The trust was broken. Collectors realized they'd been participating in a speculative bubble, not a legitimate investment market. By 2001, the Beanie Baby market was essentially dead. Values had collapsed to retail price or below. The $10 billion in perceived wealth, calculated by multiplying collector valuations across millions of owners, had vanished as completely as if it had never existed. Because in economic terms, it hadn't. Chapter 4. Who lost billions when the Beanie Baby bubble burst? The financial carnage wasn't limited to embarrassed collectors sheepishly storing toys in their attics. Real families lost real money that destroyed real lives. The most heartbreaking victims were working-class families who trusted price guides and collector magazines claiming Beanie Babies were sound investments. A factory worker in Pennsylvania spent $15,000, an entire year's savings, buying rare beanies in 1998. When the crash hit, he liquidated his collection for $800. His daughter's college fund disappeared into bins of unsellable plush. A retired couple in Florida had purchased $50,000 worth of Beanie Babies as their nest egg, believing the appreciation would supplement Social Security. They discovered too late that the only institution buying their collection was Goodwill, and Goodwill wasn't paying market rates. They sold everything for approximately $2,000, losing 96% of their investment. Small business owners who'd pivoted to selling Beanie Babies faced bankruptcy. Gift shop proprietors who'd built entire business models around the beanie craze, stocking thousands of units, paying premium wholesale prices, extending credit to collectors, suddenly held worthless inventory they'd paid real money to acquire. Shops that had thrived during the boom closed permanently during the bust. eBay sellers who'd quit day jobs to trade Beanie Babies full-time discovered their income streams evaporated overnight. One Tennessee woman had earned $60,000 annually flipping beanies in 1998. By 2000, she was unemployed with no resume-worthy job experience to show for the previous 3 years. She'd been a professional speculator in a market that no longer existed. The total destruction was estimated at approximately $10 billion in lost perceived wealth. This number is calculated by multiplying the peak valuations collectors believe their collections were worth by the actual resale values post-crash. Not all of this was invested capital. Much was paper wealth that never materialized, but millions of real dollars were genuinely lost by people who bought at peak prices expecting continued appreciation. Meanwhile, Ty Warner walked away largely unscathed. His company had generated billions in actual revenue during the boom years. While collectors lost fortunes on the secondary market, Warner had already converted his sales into real profits. By the time the bubble burst, he owned luxury real estate across America, including the Four Seasons Hotel in New York. His personal net worth remained in the billions. The asymmetry was stunning. Warner created the artificial scarcity that drove speculation, profited enormously from the mania, and bore none of the losses when the market crashed. The victims, ordinary Americans who believed they were making smart financial decisions, held the bag. They'd learned an expensive lesson about speculative bubbles, artificial scarcity, and the difference between real assets and collective delusions. Chapter 5. The $10 billion lesson. The Beanie Baby crash of 1999-2000 destroyed approximately $10 billion in perceived wealth. But the total economic impact extended far beyond individual collector losses. The bubble's burst revealed fundamental truths about speculative markets that applied just as much to cryptocurrency, NFTs, and modern collectibles as they did to stuffed animals. First, the scale of the delusion was massive. At the peak in late 1998, the collective perceived value of all Beanie Babies in circulation reached an estimated $10 to $15 billion based on price guide valuations. Millions of American households believed they owned valuable assets. The crash proved that perceived value and actual value are completely different concepts. Perceived value only exists as long as someone will pay the listed price. When buyers disappear, so does the value. Second, the speed of collapse was devastating. The bubble didn't slowly deflate over years. It popped in weeks. Prices that had climbed steadily for 5 years fell 90% in a single Christmas season. This velocity of collapse is characteristic of speculative bubbles built on emotion rather than fundamental value. Once the psychology shifts from greed to fear, there's no floor to catch falling prices. Third, the bubble demonstrated how ordinary people become speculators without realizing it. Most Beanie Baby collectors didn't think they were gambling. They believed they were making prudent investments based on published price guides and observed market behavior. They saw prices rising month after month and extrapolated that pattern into the future. This is the psychology behind every bubble. Recent past performance becomes expected future returns. Fourth, artificial scarcity only works until it doesn't. Ty Warner's retirement strategy was brilliant until everyone recognized it as manipulation. Once collectors understood Warner was arbitrarily controlling supply to drive speculation, the magic disappeared. Modern comparisons to NFT drops and limited edition sneakers follow identical patterns. Artificial scarcity creates temporary value that evaporates when buyers recognize the manipulation. Fifth, liquidity is an illusion in speculative markets. During the boom, collectors could point to eBay sales proving their beanies were worth thousands. But when everyone tried to sell simultaneously, there were no buyers. The liquidity that seemed abundant during rising prices vanished completely during the crash. Your asset is only worth what someone will actually pay, not what a price guide claims. The $10 billion that vanished wasn't destroyed in the traditional sense. It never really existed. It was collective belief given a dollar figure. When the belief evaporated, so did the billions. This is the fundamental nature of speculative bubbles. They're built on consensus hallucinations that feel real until they suddenly don't. And the saddest part? Despite this expensive lesson, America would repeat the exact same pattern with houses in 2008, cryptocurrencies in 2018, and NFTs in 2022. The asset class changes, but human psychology remains constant. Chapter 6. Warning Signs Today. 25 years after the Beanie Baby crash, the warning signs are everywhere, if you know how to recognize them. Warning sign 1. Artificial scarcity. When products are deliberately limited for no reason except to create urgency. You're watching manipulation. NFT drops with countdown timers. Sneaker releases with tiny quantities. Limited edition products that generate more revenue through scarcity than quality. Ask yourself, is this rare because it's valuable, or valuable because it's rare? Beanie Baby collectors learned this distinction expensively. Warning sign 2. Price guides instead of markets during the Beanie craze. Magazines published valuations that had no relationship to actual sales. The same happens today with speculative assets. If someone must tell you what something is worth, rather than showing you active market transactions, you're probably looking at aspirational pricing, not reality. Real assets have transparent markets with visible buyers and sellers. Warning sign 3. Investment language around non-productive assets Beanie Babies produced nothing. They generated no income, no dividends, no cash flow. Their only value came from finding someone willing to pay more than you did. This is speculation, not investment. Today, watch for investment language around collectibles, art, or assets that produce no returns except hoped for appreciation. Real investments generate value independent of resale. Warning sign 4. Mainstream media coverage of get-rich stories. When evening news features stories about ordinary people making fortunes in a particular market, the bubble is nearly finished. The beanie craze peaked when national media covered collectors getting rich. The same pattern repeated with house flipping in 2006 and Bitcoin in 2017. Mainstream coverage means the last buyers are entering the market, the greater fools who'll hold the bag. Warning sign 5. Justifications that start with, "This time it's different." Beanie collectors insisted their market was different because of eBay, the internet, or global demand. Every bubble generates unique justifications for why historical patterns don't apply. Today you hear identical reasoning about blockchain technology, digital scarcity, or global markets. The justifications change. The underlying bubble psychology doesn't. The bottom line, the Beanie Baby crash taught a generation that perceived wealth isn't real wealth. That artificial scarcity is manipulation, not value creation. That speculative assets can collapse faster than they rose. And that ordinary people can be convinced to gamble retirement funds on fundamentally worthless assets if the collective delusion is strong enough. $10 billion in perceived value vanished because it was never real value to begin with. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial educational mysteries.